All right, the reg exam loves to ask about an annuity. So you got to know something about an annuity, and here's a great way to explain to you what an annuity is. Diane, age 61 and head of household, purchased an annuity on November 1st, year 15, so towards the end of year 15. She invested $60,000 in an annuity. An annuity is an investment that's going to pay you income. The annuity will provide payments to Diane of $5,000 per year for the rest of her life. Now that $5,000 is a payment, some of which will be considered taxable income and some of which will be considered a return of her own $60,000 investment. Now Diane is expected to live for 260 months at the start of the payout period, and the payout period begins January 1st, year 16, just a few months after she invests the $60,000. Diane receives a total of $5,000 in year 16. Let's see what they want to know. Number one asks, how much of the payout is excludable to Diane in year 16? So she got a payout in year 16 of $5,000. How much of that is excludable in year 16? And the way the annuity works is that you take the investment of $60,000 that she made, divided by the expected monthly life, which is 260 months. They'll always give you that on the exam. They'll tell you, they told you here, that Diane's expected to live for 260 months at the start of the payout period. So you would divide the cost, the investment itself, $60,000, by the life expectancy of 260 months. And you would get a total of $230.77. Okay, what do you do with that? Well, that's the excludable portion of the payout. So that means $230.77 every month is going to be excludable. So to get the excludable portion, you would take the investment itself, divide by the life expectancy, and since the life expectancy is given at 260 months, then the outcome of this division problem would be your excludable monthly amount. So 60,000 investment divided by 260 months tells you that every month $230.77 is the excludable portion. Now, there were 12 months in year 16, so you would multiply 12 months because she got paid the full year. So 2769.24 is the excludable amount that she received in all of year 16. What's the total amount that she received in year 16? Well, they told you that she got a total of $5,000 in year 16. Well, the excludable amount is 2769.24. So if 2769.24 is the excludable amount of the $5,000 that she received in year 16, then they could have asked you the opposite question. How much is included as income for Diane in year 16? And that would be the 2230.76. That would be considered income under this annuity for her, and that would be taxable. So one of the reasons they love annuity is because they can ask you questions like, how much is excluded, how much is included, and that's where they'll likely go. So annuity is just one more thing you have to know something about to pass reg. Now this question could go on and get a little bit more sophisticated. Let's see what happens. Let's take a peek at question 2. It says, how much income is taxable to Diane in year 16? Round to the nearest dollar. So we already know something about what's taxable in year 16. We know about the annuity. So the annuity alone in year 16 is going to result in $2,230.76 of taxable income, because if you remember, the exempt portion was the $2769.24. So far, the answer to this question includes 2230.76 is taxable, and let's see some of these other items in the new facts for question 2. So it says, in addition to receiving $5,000 from the annuity, and we handled that, Diane received interest from state of New York bonds in year 16 in the amount of $2,000. Well, what do you know about state of New York bonds? They're municipal bonds. And what do you know about municipal bonds? They're tax-free. So that $2,000 will not be included income for Diane. And she settled a workers' compensation lawsuit, which is also tax-free, and she got $8,000. So that's probably going to be tax-free, although it says 200 of it was interest income. So 200 will be taxable because interest income on a lawsuit settlement would be included in income even if the lawsuit itself was tax-free. So far, add $200 to what we got from the annuity. And now let's go on to Social Security. Social Security of $4,000. Well, if her income is this low, then she's not even close to the threshold for where any of her Social Security would be taxable. You got to get to be around $30,000 before any of your Social Security income is taxable. So she's not even close. So it looks like all $4,000 of the Social Security income is tax-free. And then one more thing, she took an IRA distribution, and that's always taxable, of $9,000. So that's going to be income. So let's go with the $9,000 IRA distribution. We'll add that to what's taxable from the annuity. And then there was interest income from the workers' comp settlement. So if we want to know how much is taxable for Diane, we start with what's taxable from the annuity, and that came out to $2230.76. Then there was interest on the damages award of $200, and then the IRA distribution of $9,000. So Diane's income would be $11,431, rounding it off there, and that would be her income. None of the Social Security benefits would be taxable because she's not even close to the limit for that. So the Social Security of $4,000 is tax-free. So is the workers' comp settlement of $8,000, and the interest income from the state of New York bonds of $2,000. That's municipal bond interest. That's tax-free as well. All right, now we're going to go back to just talking about the annuity. Assume Diane lives longer than the 260 months that she was estimated to live at the time the payout started. Assume she lives longer than that, and it is now year 46, and she's 90 years old. And she gets $5,000 because remember, she was going to get $5,000 a year for the rest of her life, no matter how long she lived. If she lives this long, and now it's year 46, she's 90 years old, and she's lived longer than the 260 months that was estimated, look what it's asking. How much income from the annuity is going to be taxable way out in year 46? And the answer is all $5,000 received would be taxable, because if the annuitant lives longer than the expected factor, which was 260 months, then the entire amount received after that is income. So once she lives longer than the 260 months and she continues to receive payments, those payments received after the 260 months are all income. So all $5,000 would be income every year from now on. So in year 46, all $5,000 is income. If she lives in year 47 and receives $5,000, that's going to be all income. So as long as she lives, all $5,000 a year will be considered taxable income. All right, now let's look at this the other way. Assume Diane died before the 260 payments are collected. She died in year 18. That's only a couple of years into the contract, right? The contract was she would put up $60,000. They would pay her monthly based on an estimated life of 260 months, but she died in year 18. So the unrecovered portion of the $60,000 that she paid for the annuity is $50,000 because they gave her $5,000 in year 16, they gave her $5,000 in year 17, and they're telling you on the exam that the unrecovered portion of the investment is $50,000. They're asking you what happens to the unrecovered portion for tax purposes on Diane's final income tax return. Letter A says it's not deductible. B says it's deductible to arrive at AGI. C says it's a long-term capital loss deduction. And D, it's an other itemized deduction. And the answer is D. It's an other itemized deduction. If an annuitant dies before the payments are collected, the estimated payments based on estimated life. So if Diane dies before the 260 payments are collected, there's an unrecovered portion, in this case $50,000. That's considered an other itemized deduction on her final income tax return, Form 1040. So on the 1040, it would look like this. Here's Schedule A, and you would scroll down itemized deductions until you got to other itemized deductions, line 16. And right there with gambling losses, you would have the unrecovered portion of an annuity based on death. What else would go on this line? Other itemized deductions. We got gambling losses here. We have the unrecovered portion of an annuity would go here. Another thing I can think of would be the foreign taxes paid, where the foreign tax credit doesn't apply. Sometimes the foreign tax credit doesn't apply, so you have to take the foreign taxes paid as a deduction, and you would take it as an other itemized deduction. So annuities are all based on that estimated monthly life that's expected at the time of payout, which they're going to give you on the exam. In this case, it's 260 months. And if she dies before the 260 payments are collected, then there's an unrecovered portion. And that unrecovered portion is an other itemized deduction. And that's the opposite of the situation where she lives longer than the 260-month estimate and is 90 years old now and is collecting still every year. Once you outlive the monthly estimate, then it's all considered taxable income after that.